What is happening in the economy and in the markets? Is inflation here to stay, or is it a temporary phenomenon? Hi, I'm Dean Barber, founder and CEO of Barber Financial Group. Join me for just a few minutes here as we talk about what's happening in the markets and the economy, a little bit about inflation, and a lot on bonds. Let's get started with the latest month in the equity markets. Take a look at this graph, and for really the first month, we've had some negative numbers. April was off the charts positive, but as we go down this graph, here's what we're seeing. We have the RSP, which is the equal weight S&P 500, the big winner in the last month, up 1.1%. Dow Jones Industrial Average slightly under 1%, followed the S&P 500 and the S&P 100. At the bottom of the pack, we have the Russell 2000, and then below that was the S&P Mid Cap, NASDAQ, and Small Cap 600. But I don't want to focus just on the last month. What I want to do is I want to take a step back, and I want to show you a year-to-date chart here. And so you see some pretty interesting dynamics start to take place. You have the S&P 600, the small cap, up 19.56% year to date. That's after losing 2% in the month of March. Second in line to that is the S&P equal weight, 17.28, and then mid cap and so on as we run down here with the NASDAQ 100 still trailing all the other indexes on a year-to-date basis. And remember, the NASDAQ was the darling of last year with all the high-flying technology stocks really racing due to what was going on in COVID. So we've got some good equity returns really across the board on a year-to-date basis. The question is, will those equity returns continue, or will they stabilize, or are we in danger of going backwards? So when we look at things from an economic perspective, things look great. And we should wind up with a good solid economic expansion this year. Unemployment continues to drop, and we see people getting out and about and doing more, and the COVID hangover beginning to wear off. And so, yes, I do believe that the economy will continue. Will that economic growth, will that translate into growth in the equity markets? I think that a lot of what's happened in the equity markets may already be baked in for the next 6 to 8 months. So it could be that these numbers are where we wind up for the rest of the year. That remains to be seen. We're watching everything very, very closely to determine whether or not we should start to trim equity positions and start to load up in some other areas that are actually looking pretty attractive right now. So the question then becomes, is what's happening in the economy really going to cause inflation? Just this week, the 2-year Treasury auction actually said just the opposite. It said, hey, this inflationary thing that we're seeing right now is very temporary. And that's exactly what the Fed has been saying. And it really pointed more to a deflationary type of cycle. And I'm not getting into all the boring details behind it and why it thinks that. But when you look at what's happening in the bond market, which we need to do here, I think it'll help explain where you should be and what you should be looking for out of the bond market. Because remember, if interest rates rise, typical bond values will fall, but not all bonds, right? Just like stocks aren't all the same, funds aren't all the same, ETFs aren't all the same, not all bonds are the same either. Let's take a look. Okay, so we're going to start with 4 very different types of bond holdings. The first one that we're going to go through here in purple, this is it's a mutual fund that is a diversified bond fund, and I'll go into the details on that here in just a second. Just below that, you have the HYLD, which is high yield. Just below that, over the last month, you have AGG, which is the bond aggregate. That's corporate bonds. And here you have HYLD, and then TLT is down here in green, and that is the 20-year Treasury. So that's over the last month. 20-year Treasury is following high yield and following corporate, and then the diversified group. I want to back this up on a year-to-date basis so that you can really see what has happened here. High yield is really the big winner on a year-to-date basis, up 4.36%, followed by the diversified bond fund of PONAX. And then you've got AGG, which again is corporate bonds. And then here is the 20-year Treasury, down 11.12%. So when you think about the fact that when interest rates rise, it hurts bonds. It doesn't hurt all bonds the same. The longer the maturity on the bond, the more that rise in interest rates hurts it. So the TLT has been really hammered this year because of what's gone on with Treasury yields, increasing by about 55 basis points or about 0.55%. So we haven't seen a huge increase, but that has still knocked that TLT down. Now, if we back this up, and I'm going to do a 3-year period, now you start to see some things that look totally different. TLT is up 23.99%, but look at where TLT was in August of last year, up 49%, now only up by 24%. So that really got hammered. You go back here on the high yield, by April 3rd of last year, negative 25, now positive 10. That means up 35% since March of last year or April of last year when the pandemic hit us low. All these bonds are going to react differently. If you look at what's here in the purple, that's the diversified portfolio. So let me show you what that really looks like. So you've got US bonds that are high yield in here. You've got inflation protected bonds. You've got non-US bonds. You've got cash. You've got US bonds that are investment grade. And you'll notice that they don't own any government bonds right now. When you take a look here at the high yield, you've got unclassified bonds, non-US bonds, high yield bonds, and typically the unclassified bonds are going to be bonds like senior secured debt or mortgage-backed securities. AGG is going to be primarily investment grade corporate, cash, and a little bit of non-US bonds. And of course the TLT is 100% 20-year treasuries. So how you mix and match the bonds within inside of your portfolio will dictate what we see as far as performance. So by and large, bonds have really struggled a little bit this year, but always remember this, bonds are a crucial part of a portfolio. And if handled properly, bonds can be what we will call a stay rich investment. Stocks are always thought to be a get rich investment. Bonds are always thought to be a stay rich investment. So with that, it's important that you have the right diversification within inside of your portfolio. The only way that diversification can be determined is by matching it to your financial plan. So I encourage you, as always, I do every single month, talk to your financial advisor, ask whatever questions you have, look at the allocation within your portfolio. How does it match up within your overall plan? Are things on track? I know that we reach out to you very frequently throughout the year to see if you've got questions, invite you in for reviews, but it's important that you keep the line of communications open with your financial advisor. I appreciate you spending a few minutes with me here for the monthly economic update. I'll be back with you next month. Thanks again for joining me today. Make sure and like and subscribe on YouTube and share this on social media. If you haven't checked out our podcast, look for The Guided Retirement Show on your favorite podcast app or YouTube, and make sure and like and subscribe to that as well.